Often, a stock's dividends will grow at a non-constant rate. In this case, we have to discount the future dividends individually to find the price of the stock. For example, suppose a stock just paid a dividend of $2, which you did not receive. If the growth rate over the next 2 years is 4% and 8.5% respectively, and then starting in the third year growth is constant at 6%, what is the price of the stock today? Assume the appropriate discount rate is 10%. So again, that $2 dividend that occurred today, that's not part of the valuation of the stock. We're not using that to find the price. It's just there to tell us what we need to be growing by the 4% and then the 8.5% to find what those cash flows are in the next 2 years and beyond. So first, let's look at a timeline. Well, here we have the time periods along the bottom, and we have the dividends on top. And again, the dividend in year 0, we're just going to put 0 since we're not receiving that first dividend. So in the first year, the dividend grows by 4%. And so we multiply that $2 times the 1.04 to find what dividend we are going to get in year 1. And we see that it's $2.08. After that, it grows at 8.5%. So we have to multiply that new 208 that we get in year 1 times the 1.085. And we get $2.26 for the dividend that occurs in year 2. And then we have this constant growth rate of 6%. And we already know how to do constant growth. We can treat that as a perpetuity. So now we know all the different cash flows, and we'll be able to find them individually, the present values. So we can treat this 226 again as a constant growth perpetuity and find its present value, and then find the present value of the $2.08 dividend in year 1 separately. So the growth rate for the $226 dividend in year 2 is constant at 6%. So we can find the value of the perpetuity of dividend payments in year 1. Now again, this is because this perpetuity equation finds us the value of a perpetuity of payments that begin in some year, and it evaluates them the year before that first payment. So that's important to understand. And so since this constant growth annuity of 226 starts in year 2, when we use this perpetuity equation, we're going to be finding the value in year 1, one period before that first payment. And so here's our perpetuity equation that includes allows the possibility that our cash flows are growing. And so that's where we see the G in the denominator. We just subtract that growth rate from the required rate of return on equity, which is our discount rate. And we plug in the dividend of $2.26, the return on equity of 10%, and the growth rate of 6%. And we find that the present value of all those cash flows that are growing is $56.50 in year 1. So now we have this value in year 1, and we have one more dividend in year 1, the $2.08. We could discount this $56.50 back to year 0, and then separately discount the dividend payment of $2.08 in year 1 back to 0, and then we could add. But to save ourselves a step, an easier way to do it would be to add it to the dividend payment first, so we can add this $56.50 to the dividend payment first because they're both in year 1. So again, we have this $56.50 that's evaluated in year 1, and we have this $2.08, which we're actually getting in year 1. So the total value of all the future cash flows of this stock in year 1 would be the $56.50 plus the $2.08, and we want to find the present value today. We want to find the price today so we can discount that new sum back one period. That's exactly what we're going to do. So again, we can find the price in year 0 by discounting the sum back 1 year. So we just add the $2.08 to the $56.50, and that takes care of all the dividends. That takes care of all the future cash flows on this stock. And we discount it one period to find the price today of $53.25. Now there are also stocks whose cash flows increase by a fixed dollar amount every year. The easiest way to see how to value these stocks are to look at a diagram of the cash flows. And this is called the Banco model. So basically what's going on here, maybe instead of your dividends growing at a constant rate of 6%, they grow by 50 cents every year, for starting in the first year and going on forever. So that's just a fixed dollar amount by which the stocks are growing, as opposed to a fixed percentage. So let's look at an example. Suppose the dividend in year 1 is $1, and then it grows by 20 cents every year thereafter. What's the price if the discount rate is 10%? So again, we have to figure out how we're going to approach this, how we're going to be able to model all of these different 20-cent increases in a way that lets us find the total present value of all of them. So let's look at a picture. So here's just a timeline, and here we've got the time periods on top, starting in the present with time period 0 and going off into infinity. So we have this $1. We start off by saying we get a dividend of $1 every year, starting in year 1. And that's going to grow by the 20 cents, but we know that we're going to be splitting up these cash flows. We're going to be kind of separating what the baseline dividend payment is of $1 from these 20-cent increases. So let's look at just this first cash flow, which is $1 in every year. We know we're going to be getting $1 every period starting in year 1 onto year infinity. So this is one cash flow that's part of this stock. Well, beginning in year 2, we're going to have these 20-cent increases. So from period 1 to period 2, we have an additional 20 cents that we get. Now from period 2 to period 3, we have yet another 20 cents because this stock is growing by 20 cents every period. But that first 20 cents that it initially grew by from period 1 to period 2 is going to be there starting in period 2 and every period thereafter. So we can kind of look at this first growth of 20 cents as its own cash flow. We're just splitting it apart from the rest of the dividend. And we can see it starts in period 2 and it goes all the way to infinity. Now again, since this is a constant growth of 20 cents, we're going to get another 20 cents going from period 2 to period 3. And so that's just another perpetuity of 20-cent payments starting in year 3, and so on and so on. So every time we get to a new period, we see another constant cash flow stream of these 20-cent increments. And this is exactly our strategy that we're going to use for valuing this stock. We're going to be able to use the perpetuity equation on all of these because that's all they are, just a bunch of perpetuities. So as we can see, this constant growth of 20 cents effectively creates an infinite amount of perpetuities because the amount of rows, if we were to keep going down, it would just keep going down. There's an infinite many number of them. So we can use the perpetuity equation on each row of cash flows and find a single value for each one. So first let's start with this first row, this $1 baseline dividend that we know we're going to get, and it starts in year 1. Well, the present value of an annuity whose cash flow is $1 and the interest rate used to discount is 10% is just the $1 divided by the 0.1, the 10%. That gives us a price of $10. And again, when is that evaluated? Well, that is evaluated in the period that is one period before the first cash flow. So that's going to be in year 0 because again, that first time period of the first dollar bill cash flow was in period 1. Now we know the present value, we can do the same thing using a cash flow of 20 cents because we can see all these other perpetuities, they all have identical cash flows. So we're going to find the same number for the present value when we use the perpetuity equation, but it's going to be evaluated in different periods. And so when we do the equation, the 20 cents divided by the 10% discount rate, we see the present value is $2. So this first row of cash flows, whose cash flow starts in year 2, we're going to get that $2 evaluated in year 1. And the third row, we're going to get it evaluated in year 2, and so on and so forth. So all those perpetuities, they just basically sum up to these $2 present values in these different periods. And now what we're going to do, which should kind of be intuitive, we're going to combine all the rows with $2 in them to form a single row. And so remember, there are infinitely many rows going down, so when we combine them, we're going to have an infinite stream of $2 cash flows. We can see that we have yet another perpetuity. So we can find the present value of all of these cash flows. Again, using this perpetuity equation, taking the $2 constant cash flow, divided by the interest rate of 10%, and we see that it's $20. Where is that evaluated? One period before the first cash flow. In this case, the first cash flow occurs in year 1, so we're going to get that $20 evaluated in year 0. So the price of the stock is just the $10 from the original $1 dividends plus the $20, which represents all of those 20-cent increments that we're going to be getting starting in year 2 and going on to forever. So the total price of the stock is $30. Let's wrap up with some discussion about different theories of the market. First, we've learned 2 ways to calculate the return on equity. The expected return on equity is based on the dividend yield and the capital gains yield, while the required return on equity is based on the beta risk. So the expected return, what we expect to return, is based on what we observe in the form of dividends and price appreciation of our stock. and the required rate of return is what investors demand, what they require based on the risk they're taking by investing in a certain company. If these two things are equal, the markets are more or less in equilibrium, and securities are fairly priced. This conjecture is based on the efficient market hypothesis. The more efficient the marketplace, the less possibility there is for someone to beat the market, since every stock is properly valued based on its risk. So basically what this is saying is if the stocks in the marketplace actually represent the sliver of the firm that they're supposed to, because remember, a stock just represents a very small percentage of the total value of a firm, its total possible future cash flow generating potential, then by investing in that sliver, you're going to be earning that rate of return that's based on the actual risk you're taking. And if that's the case, if that's actually how they're valued, then there's no way you can make excess returns on your investment. That's what the efficient market hypothesis is basically saying. Well, there are a couple different levels of efficiency. Let's go over them briefly. The first is weak form efficiency. This states that you can't make excess returns by using historical trends, by using past data, stuff that's already happened. Basically, because a stock has been going up for the last 5 years, there's no reason to believe it will continue to increase. The next is semi-strong form efficiency. This is when all information that is freely available to the public is instantly reflected in the price of the stock. Thus, investors cannot earn excess profits by looking at a firm's financial statements, but they may be able to with some inside information. So this is saying that this is a little stronger in terms of prices actually being representative of their risk than weak form, but there's still some inefficiencies here. There's still some risk that's not being displayed by the price of the stock because of inside information, because of information that maybe only employees or management or owners of the firm know about. Finally, there's strong form efficiency. The theory here is that all information, both public and private, is reflected in the stock prices. This means nobody can earn excess returns, even with inside information. So this is the most efficient type of the efficient market hypothesis, the strong form efficiency. And that's the end of part 2.